Welcome to the 15-Minute Financial Feast podcast, bringing you 15-minute segments to help you retire with purpose on time. We're serving up food for thought and bread for the head. Are you hungry to learn? Here are your hosts, Mark Triplett and Troy Westendorf.
During this episode of the 15-Minute Financial Feast podcast, we're listening in on Troy Westendorf and Mark Triplett's Lunch and Learn series, where they covered a wide variety of retirement and tax planning strategies to help you retire with purpose on time.
Hey everyone.
Hey guys.
Good afternoon. Welcome to our Tuesday Lunch and Learn. The last session we didn't have one last week.
No.
It was 2 weeks ago. We recorded that one, and that one was all about getting financially fit and physically fit for the new year.
Yeah.
If you missed that, we can get you a copy of the recording. But this is our weekly food for thought, bread for the head. This particular week, we're going to be talking about asset location and how that may be able to help become a little bit more tax efficient, how we may be able to minimize taxes in retirement by using asset location. So we're going to cover a few things. What is asset location? What is the concept of asset location? How do you align taxation of assets with the actual taxation of the account types? So we'll talk a little bit about that.
Right.
And then 3 common mistakes that we see happening on a regular basis.
Sure. So what is asset location and why should anyone even care about it?
Well, I think let's answer the first question. Why should anybody care about it? The more money that you save from paying in taxes. So it's okay to pay taxes. We all have to pay taxes as American citizens. It's patriotic to pay taxes. However, you shouldn't pay more taxes than you're legally required to.
Right.
And oftentimes folks end up paying more than they probably should because they either don't know the rules or they don't partner with somebody who knows the rules. So every dollar that you spend in taxes is a dollar that you can't use to spend with your loved ones, take your grandkids on a trip, whatever it happens to be, whatever you're passionate about. Dollars that unnecessarily go to taxes are just dollars you can't use to enjoy or give back to your community and do something positive in your community. So that's why somebody should really care about how to minimize taxes in retirement. But to really understand asset location, we have to understand that the tax characteristics of different account types, the tax characteristics of different investments, and the tax characteristics of different investment products all have to be understood in order to align them properly. So let's talk about the characteristics of account types. So that way, account types would be like an IRA or a 401k or other IOUs, the IRS. Those are we call pre-tax accounts or forever taxed accounts. You've never paid taxes on those dollars. They've been deferred, or the taxes have been deferred. And at some point when you distribute them, they're going to be taxed as regular income. So IRAs, 401ks, other IOs to the IRS. Then you have accounts like after-tax accounts. We call those maybe your savings account in the bank where you get 1099 interest income, or maybe a brokerage account invested in stocks, bonds, mutual funds that are subject to capital gains and dividend taxes, things of that nature. Then you might have an account like a Roth IRA.
Right.
Those are never taxed accounts, right? You don't get any tax break or tax deferral on the front end, but that account grows tax-free and you pull the money out tax-free. So those are account types. That's not a product. An IRA isn't a product.
Right.
A Roth IRA isn't a product. An after-tax account isn't a product. It's an account type, and there's a tax characterization as associated with each one of those account types. All right. So then we have tax characteristics of investments. Right. So different investments have different tax characteristics. So, for example, if you own a stock that pays a dividend, for example, if you've held that stock for, I believe it's 60 days roughly or longer, there's some nuances to it. But if you hold that stock long term, even less than 1 year, though, we're talking a couple of months, and you earn dividends from that dividend paying stock, those become qualified dividends. Those are taxed as capital gains. If the dividends are not qualified, they're non-qualified because you didn't hold that stock for the appropriate period of time, then they could be taxed as regular income. The capital appreciation of a stock, for example, if I own a share of ABC company and I paid $100 for it and now it's worth $200 a share sometime in the future, I'm going to pay capital gains tax on that, which is different than income tax. right? And if it's long-term capital gains, I've held it more than 12 months, so 13 months or longer, I pay long-term capital gains tax rates, which are generally lower than your regular income tax rates. So just the account, the investment itself has different characteristics. A real estate investment trust, on the other hand, throws off regular income that's taxed as ordinary income. So knowing how the investment is taxed and what characteristics that has on the income or the appreciation of that asset, that plays into this decision as well. And then lastly, taxation characteristics of products. So for example, this comes up a lot in the insurance industry. Insurance products have little carve-outs. So for example, an annuity is tax deferred, but when you pull money out of the annuity, if it was issued after 1983, it's what's called LIFO, last in, first out. So interest is the last in, so it's the first out, and that interest from that non-qualified annuity is taxed as regular income as opposed to long-term capital gains on, say, a brokerage account, for example. Okay, so that's an example of how a product type might actually have a different tax characteristic. Life insurance, on the other hand, death benefits are tax-free. I won't get into the nuances of cash value life insurance right now, but so the products themselves can have different tax characteristics as well. So when we talk about asset location, we're trying to align the account type and the characteristics of that account type. We're trying to align that with the investments that are inside that account or the investment products that are inside of that particular account, and try to do it in the most tax efficient way.
Absolutely. Yeah, when you look at, you talked a little bit about the IRAs and how they're taxed, and we're seeing that a lot recently, and maybe we're just paying more attention to it. But over the last 5 or 6 months, we've seen a lot of asset location where we're scratching our head on, not quite sure why it's set up like this, and that's a big thing when you look at the different IRAs or the non-qualified accounts, the brokerage accounts versus a Roth IRA, and how we want to be more aggressive with Roth IRAs than say an IRA if one's going to be slower growth than the other. We're always looking at Roth should be, in our opinion, should have the more aggressive, because as it grows, and if it's going to grow aggressively, it's never going to be taxed again.
Yeah, right. So if you're going to take more risk, right? If you're going to be more aggressive, wouldn't you rather do that in an account at which you don't have to share the results with the government?
Exactly.
All right, so maybe that would make more sense to be more aggressive, your growth stocks, for example, or your growth positions in a Roth IRA. But then on the other hand, if you're going to hold fixed income, like bonds, for example, or income from real estate investment trusts or things like that to generate income in retirement, then maybe that's better positioned in an IRA, which is already taxed as regular income, right? So you're aligning the tax account and the income generated from the investment, aligning that in the taxable account because they're both taxed as regular income. And then, of course, if you have an after-tax account, maybe that's where you put your dividend-paying stocks, right? Absolutely. Because the qualified dividends are going to get capital gains treatment as opposed to ordinary income tax. So just being mindful of how you allocate assets inside of a particular account can play a big role. And I'd say there are a few things that we run into over and over and over again. Three primary mistakes that we see often.
What would you say those three primary ones are, Mark, when we look at the common mistakes that we see in portfolios?
So when I evaluate an investment portfolio, so let's set aside for a moment insurance products and things like that. Just talking about an investment
and
portfolio.
Rates of return. We can
Right.
throw that aside
set
too.
that stuff aside just for a moment. What I find often is that if we look at a household portfolio, let's say Mr. Johnson has an IRA and Mrs. Johnson has an IRA, and maybe one of them has a Roth IRA, and another one, maybe they have a joint tenants with rights of survivorship after tax account. And I'll see every single one of those accounts invested in the exact same ratios.
Yeah.
So they each have the same ratio of fixed income to equities or bonds to stock. So they all have a very similar mix. Rather than being mindful and saying, well, let's take our fixed income and pile that into the IRAs. Let's take our most aggressive positions, our growth positions, or growth stocks, pile those into the Roth IRA. And if we have dividend paying stocks, for example, let's pile that into the joint tenants with rights of survivorship account, because that joint tenants with rights of survivorship account gets capital gains tax treatment. And if they're going to leave that to their beneficiaries, they're going to step up in basis at the passing, as opposed to an IRA. When you leave an IRA, it's taxable, right? You leave an IRA to your kids, they're paying taxes on it. But if you leave an after-tax account that owns stock, highly appreciated investments, when that passes to the next generation, they get to step up the basis. So their cost basis going forward is the date of your passing, as opposed to when you bought the investment. So they avoid capital gains on that. So just being mindful of how we allocate investments inside the accounts can be a big deal. But what I see often is that cookie cutter. Every account has the same investment ratio, and that just drives me wild.
Yeah.
Another thing we run into quite often is seeing aggressive growth investments in an IRA, and then having less aggressive investments in the Roth IRA. Complete opposite. Like if you're going to take risk and it's your risk, it's your money for a higher return, why would you want to do it in the account that you have to share with the IRS? Why wouldn't you want to take that aggressive position in the account that you don't have to share with the IRS? So I see that often. And the last one that we see quite often is after-tax money in an annuity. And I know there's a camp out there in the insurance industry that really promotes annuity tax deferral, right? If I have, let's say you have a CD sitting in the bank and you're earning 1% on it, and you go, I don't want to pay 1% interest in taxes every year. If you put it into an annuity, for example, you don't have to pay taxes on that. It's tax deferred. So it's an after-tax account. You put it inside of an annuity. Now it grows and you don't pay taxes on it. However, when you withdraw that money, it's going to be taxed as regular income. Okay. So what I see or what we run into are folks that don't need the tax break. Okay. So they don't need the tax relief. They're in a lower tax bracket. They're in the 12 or 22% tax bracket. It's not like they're in the up, the 30% bracket or something like that. Yeah. And they have money sitting in an after-tax annuity. They're deferring taxes at a 12% tax rate. And when they pull that money out later, whenever they pull it out, it's going to be taxable at whatever income tax rates are at that time. If they leave it to their kids or beneficiaries, are going to have to distribute that money and pay taxes on that interest that was earned, that has been deferred in there, whatever their tax rate is. When those dollars maybe could have been positioned in a brokerage account, in investments that could pass tax-free, like we just talked about, capital gains gets the step up at death, at passing. So that's another head scratcher when we see, and again, I'll stress that some people need the tax relief, and that's important to them. But oftentimes the folks that we run into are actually probably setting themselves up to get hammered later on in taxes. I mean, if I've got money that I'm going to invest, and I could pay long-term capital gains taxes, which are generally lower than income tax rates, or I could take that money and put it in an annuity and defer that, but have to pull the money out as taxable interest, last in, first out. I'm likely going to pay more in taxes later than I would if I just bid it now and dealt with it. Plus, if I pass that tax deferred interest in the annuity on to my beneficiaries, they're going to get whacked with taxes on the income from that.
Yeah,
so anyway.
We've seen that too. We've seen where they have plenty of non-qualified dollars. They've had plenty of IRA dollars, and they still chose the annuity over going into the IRA. The non-qualified versus the IRA dollars, and it's just doesn't make sense to us just for that reason, for the taxation reason. You just will use the IRA dollars for that and let your non-qualified dollars go into something where you're not going to have that taxation.
And folks who are clients of ours know that we use annuities. We call it a loss avoidance strategy. We use fixed and indexed annuities that have a zero floor. You can't lose any money during a down market. You can earn some interest when it's positive. And they really are an alternative to fixed income or the bond side of a portfolio, where we think we can get a decent rate of interest credited, remove that money from being, having fees assessed on it. There's a whole host of reasons why we might use an annuity, but generally speaking, we would not use it. We would not use after-tax dollars to fund the annuity if we can potentially get away with not doing that, using their pre-tax money. Just because when you withdraw that money from the annuity, it's going to be taxed as regular income. Why not align it in the same account that's going to be taxed as regular income? Account type IRA, pre-tax account, it's going to be taxed as regular income. That might make more sense. So
Absolutely.
Anyway, I mean, the moral of the story with asset location is just be mindful of the account type and the tax characterization of the account type, the tax characteristics of the investment or product you put in the account type, and try to align them as best you can to be advantageous from a tax perspective. And that's what asset location is all about, and just trying to be as efficient as possible.
Planning and being tax efficient with your asset location, and a little bit of planning and foresight, we can absolutely do that. It doesn't take years of planning. We can do this with a little bit of planning, a little bit of foresight, get that asset location where it needs to be, where you can be the most tax efficient in your retirement plan.
Yep. So that's it for this week. Hopefully this was informative for you. Next week, we're going to be talking about long-term care and how long-term care is actually an event. It's not insurance. I know, right?
Really?
I know everybody thinks that long-term care is insurance, but long-term care is the actual event. We'll talk about the likelihood of a long-term care event occurring in somebody's lifetime. How much of that care is actually delivered in a nursing home versus how much is delivered in their home or assisted living. And we'll kind of talk about the nuances of that, and then what the general costs are to transfer some of that risk to an insurance company if somebody decides they don't want to take that risk on themselves. So hopefully you'll join us. You can register on our website for that. Just be mindful that every dollar has a purpose.
Every dollar has a timeline.
So your dollars for retirement have a purpose, a timeline. How and when you're going to use them should dictate where those go. Until then, we hope that you strive to retire with purpose
and on time.
See you next week,
guys. Take care.
You've been listening to the 15-Minute Financial Feast podcast. Remember, every dollar has a purpose and every dollar has a timeline. If you have questions about today's topic, schedule a call with a team member. Visit www.mypt5.com. Until next time, be sure you're taking steps to retire with purpose on time. Mark Triplett is an investment advisor representative of and advisory services offered through Royal Fund Management, LLC, an SEC-registered investment advisor. Nothing contained in this program should be considered an offer to buy or sell securities. Different investments have different risks associated with them, and not all investments are appropriate for all investors.